I do want to start off here with the yield curve itself, what it's telling us, and more importantly, as Alix was kind of alluding to, how do you position around this if you're not quite sure, not just whether the yield curve will steepen, but what will actually drive that steepening?
Well, let me start, Romaine, by saying that a negative yield curve, and I use the 2 to 10 year spread, which is about a negative 23 or 24. It's been as high as 50 to 75 basis points, so it's less negative now. But when you think about it, commonsensically, when you think about it, capitalism and a finance-based economy, which is what we have, can't really do well when you can get a higher return for less risk. That's not the basis of a capitalistic economy. You need to get a higher return for more risk, and it's just the reverse now. And so, you know, I think ultimately the yield curve has to go positive in order to produce a relatively stable economy and a stable inflation rate around 3%.
Do you have faith right now in the economy and, more importantly, the folks who are shepherding that economy?
Well, no. You know, let me put it out there. You know, the Fed has not done well in the past 3 or 4 years in terms of, or 5 years, in terms of trying to find that magic Fed funds rate that will neither increase inflation or produce deflation. And so, you know, are they wise enough now to know exactly what the Fed funds rate should be at any point in time, or even, you know, 6 to 12 months down the road? You know, I'd be very cautious, and I'd view economic statistics like they do, but from an investor's standpoint that, you know, speak to fundamentals that the Fed isn't necessarily following.
Well, let me ask you, what would you do different if for some reason you were magically in the shoes of Jay Powell? What would you do different at this point?
Well, I would stop quantitative tightening. I think that's just not a correct philosophy and policy at this point in time to, you know, continue to tighten quantitatively. They should leave the, you know, the reserve balance around $7 trillion and just see what happens going forward. I also think that, yes, the Fed should lower interest rates over the next 6 to 12 months. Real interest rates are simply too high. The 10-year real interest rate is 1.8%, which historically is very restrictive. And, you know, I think not only the Fed, but I would like to see the real interest rate on a 10-year come down to 1.5% or 1%. And so the way to do that is to lower interest rates from where we have it now at 5.25% for Fed funds, and to, you know, basically balance out real interest rates and lower them so that the economy won't go into a significant recession.
So, Bill, if you think we're going to get cuts in the next, say, 6 to 12 months, are we cutting because of normalization to get that real yield kind of at a more normal level, or are we cutting because the economy looks really bad?
Well, we're certainly not talking about cutting the Fed funds rate based upon an economy that looks bad, although there are indicators such as the you know, leading indicator number that came out today, and other indicators that suggest, like we talked about in terms of the negative yield curve, that suggests that, you know, at some point we're going to see a zero line, you know, real GDP and maybe something lower. I think, you know, to basically keep an economy going in this finance-based economy that we've had for a long time now, 5, 10, 15, 20 years, you need interest rates lower than nominal GDP. That's what drives, you know, basically today's economy as opposed to what we saw 50 to 100 years ago. And so with nominal GDP at 5 and 6% and perhaps headed to 4, but we need the 10-year to be lower than nominal GDP in order to continue a you know, steady progression in terms of economic growth.
So, Bill, in that environment, does it make sense that equities are at a record right now?
I'm sorry, say again?
Does it make sense that equities are at a record right now based on what you're talking about?
Oh, no, I don't think it does. I mean, I've got some historical charts, and others have provided those for me, Bloomberg being one of them, that basically suggest that PE ratios of 19 to 20 times, which is what we're at the moment, and perhaps a little bit lower based on forward expectations, that PE of 19 times is much too high relative to a 1.8% real interest rate. Real interest rates were down at a negative, minus 2%, just as recently as 2 to 3 years ago. And so they've risen significantly, but PE ratios haven't really dropped. And so I think ultimately, and this is a long-term type of statement and a long-term thesis, ultimately PE ratios have to get more in balance with real interest rates, which are relatively high now.
That certainly, Bill, seems to be a question for those folks who are looking for an entry point into this market. For those folks who are already invested, and particularly those folks who piled into a lot of those big cap tech stocks, the Magnificent Seven, and even if you broaden that out, basically kind of the top 14 here, is that also a signal that maybe they should be looking for the exit?
Well, maybe not the exit, Romaine, but certainly in terms of additional funds going into those Magnificent 7 or 14, as you mentioned. It's probably the time to cool it off a little bit and to put your money elsewhere. That's always a difficult statement in terms of timing, because if I'd said this a month ago, I would have been more of a fool than I might be a month from now. But I think there are values in the market. I'm not suggesting get out of the market. I'm suggesting that perhaps you should be a little more conservative, but you need to be invested. A 5% Treasury bill, yes, that's attractive, and I have some. But basically, there are certain stocks with higher yields, relatively safe dividends that are more attractive to me than the Magnificent Seven.
Like what, Bill? Are these places where you yourself have put your own money?
Oh, yeah. For instance, I've talked about the master limited partnerships for pipelines that yield 8 to 9% with a tax-deferred type of status. And, just this morning, Romaine, Newstar, which is one of those MLP pipelines, was not purchased yet, but there was an offer from Sunoco to buy Newstar at a 10 to 15% premium. And so with yields at 8 to 9%, and with this type of value and attraction from other companies that are in the takeover type of business, I think that's one clear example of what you should be buying relative to the Magnificent Seven.
And we'll definitely get more to M&A, because I know Romaine's super excited about M&A, ARB, so hold that thought. But I just want to get your quick take on certain other areas of the equity market. What about banks, for example? What about REITs? What about areas where you can get some good yield and maybe some more risk is priced in, they're trading really cheaply? What do you do with those areas?
Well, I like them. As you know, I've sort of become famous or infamous in the past 5 or 6 months talking about bank stocks and how they were, relatively historically cheap with a book to price to book type of ratio at about a 0.5, which is about as low as they've ever gone. Now it's much higher. They've done well, but there are certain bank stocks that I own that yield about 6%. One of them is CFG, another is KEY, another one, Truist, TFC, which is down today. But these are attractive type of situations with 6% yields and still some upside. Although at this point they're probably going to level off too.
Bill, I guess a good question is, I understand why you like those names and why you like the dividend yield, but none of that is big tech and the AI trend and semis. How do you play the trend without buying into the big guys that are already expensive? Is there a happy medium for Bill Gross?
Well, I don't own any of the Magnificent Seven, although I think Microsoft is certainly a great long-term value and can be bought, at this point with expectations of an attractive return going forward. There's a stock in Europe, in Euroland. There's basically the Microsoft of Euroland. Symbol is EPAM, and it trades at a much cheaper value. It's got some interests in Poland and so on, which are geopolitically risky, but I think that's an attractive situation. And, so you can pick and choose, but for the most part, the Magnificent Seven are not on my buy list.
All right, well, let's talk about some of the other things that are on your buy list, at least what we know publicly. You have been involved in some merger arbitrage plays, including Capri Holdings and at least a couple of others here. Why do you find just overall merger arbitrage attractive in an environment where, quite frankly, there doesn't seem to be that many mergers anymore?
Well, we just had one this morning with Newstar, but yes, I think in terms of Capri, it was just approved basically by China a few weeks ago in terms of the potential going forward, and that tends to be a relatively consistent indicator of what we might do here in the United States. Capri's trading around 40. It's got a buyout around 47, and so that's 7 points on a base of 40. So that's about a 17% return, over the next 6 months if it goes through. So there's certainly some risk there. SPLK is another one. It's called Splunk. Yeah. And Splunk is an attractive situation with a smaller total return, maybe 4 or 5 points going forward, but it, consistently moves higher each and every day. And so, these aren't NVIDIA type of stocks, but they're, it's situations where you can certainly outperform Treasury bills with a, pretty good margin of safety.
I am curious when we talk about the idea of sort of whether these deals go through. There's been so much talk about some of the deals that either failed because of regulatory pressure or maybe just because the buyers or the sellers got cold feet out of it. I am curious as to whether it's easier or harder to sort of assess these sort of the potential for these mergers to actually make it through, given the regulatory environment, given the cost of capital to finance it, and quite frankly, given investor appetite, which at times seems to be a little bit tepid for these types of tie-ups.
Yeah, I think it's harder, Romaine. There's no doubt the conditions that you just mentioned, make it more difficult. But, we're talking about relative value here compared to the Magnificent Seven and some of the others at stocks at 19 PEs. And so it just seems to me that, a relatively conservative investor can make a 10 to 15% annualized type of return without as much risk as being in high-tech stocks.
Hey, Bill, looking ahead, it's an election year. New Hampshire primary is today. Do you have a President Trump 2.0 playbook yet?
Are you talking about DWIC, digital?
No, I'm talking about
world.
If President Trump becomes a president again.
Oh.
What do you do? Where do you go?
Well, that's certainly a risk. So we have political risk domestically. We have geopolitical risk in terms of, a number of situations around the world. So what do you do? Typically, you remain very cautious.
So what does cautious mean? Does that mean you want to go buy the 10-year? Is it buy the dollar? Is it get out of certain positions? What does cautious mean for Bill Gross in that environment?
Well, I think it means, going for an attractive yield, an attractive dividend that's, consistent going forward. I don't really want to mention this because these stocks are not on the favored list of any investor, but tobacco stocks like Altria yield 9.5 to 10%, and the dividend has been raised every year despite the problems with the tobacco industry. There are stocks like Verizon and AT&T that yield 6.5 to 7%, and so you can go to areas where there's perhaps still some growth, like with Verizon and AT&T, and a high yield at the same time. It just seems like a better bet for an investor that wants to conservatively, earn perhaps double digits going forward.
All right, Bill, I'm going to save you from the political questions from Alix. Well handled there. I am curious about opportunities outside of the United States. There's been a lot of discussion about how basically one of the best performing markets out there isn't the U.S., it's Japan. There's been a lot of discussion here about how there is a lot more money that's coming out of China and looking for a place to go in sort of, I guess, the developing world, if not to Japan itself as well here. Do you look at a turning point in any of those markets that might provide, at least on a relative basis, a little bit more return than what you can get here in the U.S.?
Yeah, I think so. I'm looking, and I've dabbled a little bit because, as you point out, Romaine, non-U.S. stocks have not done well relative to the rest of the universe. Japan is doing, better this year and last year, but there's an ETF by the symbol of VEU that contains all or most stocks that are non-U.S. related, and so it's a long-term timing situation in which the expectations for this have to turn around. But I think there's more value in European stocks than in the United States based upon price earnings ratios and other considerations. Stocks like Volkswagen, for instance, or BMW, gosh, the PE ratios there are 2 to 3 to 4 times relative to GM and Ford and certainly Tesla. And so, yeah, there are considerations outside the United States that I think an investor should look at.
This is interesting, Bill. I mean, I always love talking to you. I mean, for a guy who basically made his name and his fortune in the fixed income space here, you really seem to have a very interesting view about just the pace of equities right now and the attractiveness there. Is it more exciting now for you to, I guess, do what you're doing? Obviously, you have the independence to do whatever the heck you want now, but is it more exciting, to, I guess, to be more in that space than in bonds and fixed income?
Well, yeah, I think it is. The volatility is higher, but to be fair, I'm still in the Treasury market with puts and calls and options, and even if you don't have a bullish outlook on the 10-year Treasury, which I don't, you can still make a decent return by doing a spread trade, a put and a call spread trade that over a month's period of time can provide a decent return. So, yeah, it's more exciting to be in stocks. And Romaine, one of the considerations in the stock market is consistent with what I did at Pimco. Stocks are a volatility type of consideration. At Pimco, we sold volatility consistently going forward based upon mortgage pass-throughs, et cetera, et cetera. And so, I like dabbling in the equity market more than bonds, but bonds are still there.
I don't think I ever would have thought that Bill Gross would say that. Bill, before we let you go, I would kick myself if I didn't ask you this. We are having exploding fiscal deficits in the U.S. Whoever takes the White House, that's going to continue to grow. At some point, do you think the bond market can start telling Washington, D.C. to trim more fat, like the bond market did in the U.K. with former Prime Minister Liz Truss?
Well, hopefully, yes, but I don't think the bond market can tell Washington anything. I think it's Washington that dictates the bond market. Washington is concerned in an election year with maintaining a deficit of $1.5 trillion or more in order to keep nominal GDP higher. And so, Yes, I think this election year is important, but I don't think the bond market, even under a supply consideration that suggests higher interest rates, is going to do much good in terms of giving a lesson to Washington. It's vice versa.
Do you think we're going to actually see that lesson, I guess, in your lifetime, in my lifetime, or is this just something that our children or grandchildren are going to inherit?
Well, demographics argue for higher deficits going forward with Social Security, with Medicare, with Medicaid. It seems to me that we're in a situation where long-term deficits, as far as the eye can see, are going to be consistently high, not just here, but in Euroland and elsewhere. It's simply a situation now where there's too much debt, and in order to, keep that debt rolling and keep the economies rolling on a nominal basis, it's necessary on the part of central banks to maintain a relatively easy monetary policy, and the same thing with fiscal. I think $1.5 trillion deficits are here to stay.